Hey guys, this is Rudy coming at you live from Palm Beach in Florida. It is Thursday evening. It's about 9:30 p.m. And I'm a little bit behind because I've been doing lots of stuff and attending a trade show and all kinds of things that has been keeping me busy. But I do have some homework to do, including some that you gave me. So to start off with here, what I want to do is talk a little bit about enterprise product partners. Zande 191, Zande 191. A week ago said, thank you for the video. That was the video on Alliance Resource Limited Partnership. Could you please do one on EPD earnings today? Now, of course, that's a week ago, but that's when they reported. So here's my video sort of 1 week late on Enterprise Product Partners. This is a great company and probably one that you want to add to your watch list if you're not long already in this particular limited partnership, assuming, of course, based on your jurisdiction and your tax jurisdiction, especially, you have the ability to invest in US limited partnerships. Anyway, Enterprise Partners reported last week and their earnings per share came in at 66 cents, beating the consensus estimate of 64. So a nice little beat there. Total revenues of 14.8 billion, topped the consensus estimate of 13.4. So a nice beat on the top and bottom line. And they said the strong quarterly results can be attributed to increased operating margin on enterprise product partners, fee-based businesses. Now, of course, enterprise product partners is very similar to one of my long positions. I don't have a position in enterprise product partners at all, but I have a very large position in energy transfer, which is not dissimilar. In fact, they are very, very much alike. Looking at a quick snapshot here. So I took the snapshot that I'm showing you here a few days ago. This was on May the 2nd. Obviously, it's now almost a week later. Anyway, the price at around $28 is still more or less where it's trading right now. So things haven't changed too much. So I can use this slide without having to necessarily update it. We have a large cap value stock here at $60.8 billion market cap. Decent PE ratio, a very, very good dividend yield of $2.06, which at the current price yields approximately 7.5%. It's quite a large institutional holding at 24%, given the fact that it's a limited partnership. Very often institutional investors do not want to be bothered with receiving a K1 for tax filing at the end of every financial period, at the end of every financial year, I should say. In the 52-week range, we can see it's sort of sitting just right of center. The 52-week range between 25 and $30. So you can see it hasn't moved too much. It's sort of sitting in the middle of that now at around $28. It's been an underperformer compared to the indices. So the three major stock exchange indices, the Dow Jones Industrial Index in light blue, the S&P 500 in purple, and the mustardy color, the NASDAQ. And you can see that the enterprise product partners black line there has sort of underperformed the indices and maintained that underperformance to a large degree. But of course, do take into consideration that pays a dividend yield of almost 7.5%, which you can use to boost your return on investment. So I mentioned energy transfer is one of my largest positions. You'll see it here on the far right. That's ET. Looking at some of Enterprise Products Partners' other peers, we have EOG Resources, Marathon Petroleum, and Phillips 66. And looking at the slide over here, you can see that they are sort of more or less similar in terms of size. So they're all sort of mid to large cap value stocks. The largest of the bunch being EOG Resources. The dividend yield, of course, is very attractive for dividend investors, including myself, and that's why I hold energy transfer. But you can see EPD on the far left and energy transfer on the far right at 7.5%, 8% is a pretty good dividend yield. And obviously the stock market and the stock ticker is going to go up and down in terms of the share price. But the dividend yield is generally fairly constant and somewhat predictable as a form of revenue or passive income. Right at the bottom of the screen, you can see the price earnings ratio for these five. And at a quick snapshot, if you use the price earnings ratio as a benchmark in terms of helping you to make a buy decision, you can see Marathon Petroleum is the cheapest based on its PE ratio at just under 9. But to be fair, they're all sort of in line with the exception of energy transfer, which is a little bit higher. I'm okay on energy transfer, even though the price earnings ratio is a little higher because my cost base is about $9. So I'm okay with that position in terms of where it is right now. For the technical gurus, Looking at the 20-day raw stochastic, now you'll probably know from what I shared with you before, if it gets to above 80%, it's been overbought, and that's probably not a good time for you to get in. None of these are over 80%. Conversely, if it's below 20%, it's probably very oversold. So at a quick glance here, and now I've ranked them sort of in alphabetical form. So my long holding here, Energy Transfer, is not a buy right now if you use the 20-day raw stochastic compared to the other four. Now, in one way, you can say it is a buy. It's got a price earnings ratio of around 12 or whatever, and a 20-day raw stochastic score of less than 80. So using those two as a benchmark, it's certainly a buy, and some of the analysts think it's a buy. In fact, they say it's more a buy than any of the other four. However, the lowest stochastic score here is actually Enterprise Product Partners, which is probably one of the reasons why Zande said take a look at that one, along with Marathon, pretty good. So if these are the type of technical indicators that you're looking at in terms of making a buying decision, you can add some of these to your watch list, and they would include Enterprise Product Partners for sure. From a price earnings point of view, Marathon looks the best once again, but anyway, it varies, right? So what I'm doing over here is I'm taking the annual sales of the issuer being the one that issues the stock. So using EOG Resources as an example here, I'm looking at the annual sales, $24 billion, and the market cap, $74 billion. And you can see there's a 3x there. So in other words, their market cap is approximately 3 times their annual revenue. If it's around 1, it's very attractive because that means the valuation from a market cap point of view is almost equal to revenue. So the cash that they're generating is almost equal to its market capitalization or market valuation, which is the number of outstanding shares multiplied by the current share price. And if it's below 1, then it becomes even more attractive. So you can, as an example, look at some of these here. And let's look at Marathon as a great example, 0.4, right? So it's generating $148 billion in revenue, and it has a market cap of only $64 billion. All of them pay dividends. The most recent earnings dates have all passed with the exception of Energy Transfer, which was just yesterday. So in other words, they're all sort of going back a few days, and Energy Transfer was the latest one to report. So I still have to look at that one because I'm still busy catching up. But for Zande, I'm first looking at Enterprise Product Partners. If you look at this on a graph, so if we look at it in picture form for the people who like graphs better than tables and rows and columns, over a 1-year period, you can see that these two guys here, so the pinkish line, purplish line here at the top is Marathon, and the green one is Philips. They have outperformed the others handsomely. Energy Transfer, my long, has not done too badly, 26%. And if you reinvest the dividends, you're well over 30% because it pays dividend of around 8% on an annualized basis. And the laggards here, to a lesser degree, the other two. So not a bad performance in general. I mean, if you were long in any of these, you're probably happy. But look at this, if you were long on Marathon, you're up 60% in 1 year. That's a pretty good performance by anyone's standards. Going back to EPD specifically, so Enterprise Product Partners seems inexpensive. We're looking at the PEG, so the price earnings from a growth point of view and price to book. They're the most appropriate valuation measures because it's got positive earnings, right? So the price to earnings ratio is trading 12 months. We've talked about that already. And then right here at the bottom, the PEG. So the PEG ratio is also trading 12 months. So price earnings growth ratio. When you look at that one, you can see it is certainly better than the industry. And as a general rule, looking at this as a snapshot, Enterprise Products Partners is inexpensive in terms of its peers, in terms of where it currently is. And now here I'm comparing it to the industry rather than just 4 of its peers. From a profitability point of view, so I kind of changed the color coding on the arrows here. It says EPD has inline profitability with the oil, gas, and consumables fuels industry. But, everything is not necessarily the same, and these things are not equal. I could probably have gone red, amber, and green like a traffic light, but the gross profit margin is okay at 21%, but the industry overall is 41%. That gap narrows a little bit, so the delta is not that huge when you look at the operating profit margin. That's why I put it in yellow. We have a 13.9, so 14% compared to the industry, almost 20%. And then the net profit margin delta narrows a little bit again. That's why I put it down here in green, because it's kind of creeping up to be more in line with the rest of the industry at 11.3 compared to 15.23. So not too bad overall, but certainly from a gross profit margin point of view, not even close, right? So to its industry peers. From a growth point of view, the performance is on par. Once again, I've kind of used different color arrows to make my point. The difference here is the earnings per share growth for the most recent quarter is not the same as the trailing 12 months, and the revenue growth for the most recent quarter is not the same as for trailing 12 months. So when you look at the EPS growth, so the earnings per share growth for the most recent quarter is pretty good, because it's positive 2% and the industry was negative 14. And for the most recent quarter, it was really good, 19% compared to the industry's negative 22. Then if you go down a little bit, for the most recent quarter, the revenue growth was very good at 20% compared to negative 5. But then look what happens to the revenue growth over the trailing 12 months, negative 14 to the industry's 14, which is positive. So a bit of a hit and miss story here, but for the most part so far, more of a hit than a miss. I like enterprise products here. If you're not long in enterprise products partners, you can certainly add it to your watch list and maybe mark it down as something that you want to buy, unless you already have something similar. Like I have energy transfer, so I'm not going to be buying energy products because if you do that, you're basically building a concentrated position in one particular sector or segment of the market. From an effectiveness point of view, it's okay. Return on equity assets and investment, it's lagging the industry, but the numbers are not too bad, especially if you look at assets and investments here. The return on assets, 8 compared to 9, and then return on investment for the trailing 12 month, 10 to 11. So pretty much the same thing. Not too concerned or interested in revenue per employee. That's a benchmark that doesn't really mean anything to me, and certainly wouldn't impact my buying decision at all if I were to go long in this particular investment. From a financial strength point of view, you guys know I always look at the debt, right? Enterprise Products Partner should have very little difficulty repaying its debt. Now, there are 2 points here that are interesting, right? So in the first place, EPD's total debt to capital ratio for the most recent quarter is almost 50%. The industry is down to 29. So the industry has done a much better job collectively in terms of balance sheet repair while prices were higher compared to enterprise product partners. Quick ratio, this is not good at all. You want to be at 1 or above. The quick ratio telling you how much cash and cash equivalents you have on hand. So, sorry, in terms of the quick ratio, it's just cash compared to how many payables you have. The current ratio would be cash equivalents compared to how much short-term liabilities or near-term liabilities that you have to pay within the next 30 days or so. You want to be at 1 or above. So this is not a good number. As I've said many times before, anything below 1 is flying a little bit too close to the sun. But this is not bad. And the reason why it's not bad is because the company's operating profits are 9 times greater than its interest payments. So enterprise product partners would have very little difficulty repaying its debt. So that's kind of a wrap on enterprise product partners for Zande 191. What do you guys think? Is this a buy or a sell or a hold year? So when it comes to sort of pipelines in general, the companies that are the largest in the United States, so Energy Transfer and Enterprise Product Partners, also mired in ongoing litigation from a whole variety of different sources in terms of their pipes that are in multiple states and crossing native land and all kinds of things like that. I have additional pipelines also in Canada with Enbridge, which owns many tens of thousands of pipelines in Canada. So I have quite a large position in pipelines already in my portfolio right now with Energy Transfer and Enbridge, which is Canadian. So that gives me a little bit of price diversification, in addition to the fact that Enbridge is also a utility supplier for natural gas to people who live in Ontario, which is Canada's most populous province. And they also do quite a lot of additional oil and gas and consumable fuels type products. Energy Transfer, on the other hand, is one of the largest pipeline operators in the United States, similar to Enterprise Product Partners, but Energy Transfer also owns Sunoco, so they even have diversification into retail. So for me, if I didn't have Energy Transfer or Enbridge in my existing portfolio, I would certainly add Enterprise Product Partners to my watch list. In fact, it will do very little harm opening up a position in enterprise product partners at the current price of around 28 bucks. Tell me how you think or how you feel in the comments. I look forward to hearing from you. Are you long in enterprise product partners or in some of the others that I mentioned or that I included in my comparison? If so, why? If not, why not? And let me know what you think. Is this a buy, a sell, or a hold? I look forward to chatting with you, and I'll see you guys soon. Take care. Bye-bye.